Now, here's my specific prediction. Silver will be back above $120 by February 15th. Not by March, not by summer, by February 15th. 17 days from now, here's why. This crash brought silver from $121 to $108. $13 down. That's substantial in 60 minutes. But it's nothing compared to the rally that preceded it. The pattern from December suggests we bounce. The fundamentals suggest we bounce. The oversold conditions suggest we bounce. And February 15th is when the shutdown drama will be resolved one way or another. That's when the fear subsides. That's when buyers return. 120, February 15th, on the record. Let me give you some actual takeaways because understanding what happened is useless if you don't know what it means for you. If you're holding physical gold and silver, the answer is simple. Do nothing. Physical metal isn't a trade. It's not something you buy and sell based on daily price movements. Physical metal is insurance, long-term savings, wealth preservation. You don't sell your insurance policy because the stock market had a bad day. You don't liquidate your savings account because there was a market crash. Physical metal is the same. You don't have a loss until you sell. Until you sell, it's just a number on a screen. It doesn't affect your life. It doesn't change how many ounces you own. Ignore the daily noise. Come back in 6 months. Come back in a year. The fundamentals haven't changed. The long-term thesis hasn't changed. Only the short-term price changed. If you're trading with leverage, today was your wake-up call. Leverage in volatile markets isn't risky. It's a death sentence. Liquidations triggering liquidations. That phrase should stay with you because that's exactly what happens when leverage traders get caught on the wrong side. You think you're smart. You think you can handle the volatility. You think your stop loss will protect you. And then price gaps down. Your stop loss gets skipped. You get liquidated at a price far worse than you expected. Your account is gone. This happens every single time there's a sharp crash. Leverage traders get wiped out every single time. If you're using leverage on gold or silver, reduce it dramatically or eliminate it entirely. The potential gains are not worth the risk of total wipeout. If you're waiting on the sidelines with cash, this might be your moment. The best time to buy is when there's blood in the streets, when fear is everywhere, when people are panicking, when red candles are stacking. That's when smart money accumulates. That's when the wealth transfer happens. From the panicked to the patient, from the fearful to the prepared. But only buy what you can't afford to hold through more volatility. Because I can't promise this is the bottom. There might be more pain. There might be another leg down. Buy in tranches. Don't go all in at once. Buy some now. If it drops more, buy more. Average into your position. And only use money you can afford to lock up for months or years, not money you need next week. If you bought at the very top, if you bought silver at $121 or gold at $5,600, I'm not going to sugarcoat it. It hurts. Watching your portfolio drop 11% in an hour hurts. But you have two choices. Choice one, panic, sell at the bottom, and lock in your loss. Make the loss permanent. Transfer your wealth to whoever is buying from you right now. Choice two, hold through this volatility and wait for the recovery. Accept that you bought at a bad time, but recognize that bad timing isn't the same as a bad investment. If the fundamentals are still intact, if the long-term thesis is still valid, then your only mistake was timing. And timing mistakes get corrected over time. History favors the patient. But you have to be able to survive the drawdown emotionally. You have to be able to watch red without panicking. You have to be able to hold when everyone else is selling. Can you do that? Only you know the answer. Let me give you some perspective. In 2020, gold crashed 30% in March. People panicked. They sold. They said gold was dead. By August, gold hit all-time highs. In 2008, silver crashed 50%. People said silver would never recover. 3 years later, silver hit $50. Every single bull market has corrections. Every single one. The question isn't whether corrections happen. They always happen. The question is whether you have the conviction to hold through them. That conviction comes from understanding. If you understand why gold and silver are rising long-term, you can stomach the short-term pain. If you don't understand, every crash will shake you out. You'll buy high and sell low over and over again. Markets are designed to transfer wealth from the impatient to the patient, from the emotional to the rational, from those who react to those who prepare. On January 29th, $6 trillion changed hands in 60 minutes. Some people lost that money, other people gained it. The question is, which side of that transfer you were on? If you panic sold, you transferred your wealth to someone else, someone who was waiting for this, someone who understood the game. If you're still holding, you still have a chance. The game isn't over. And if you're sitting in cash, watching from the sidelines, waiting for your moment, pay attention. Because moments like this don't come often. December crashed, January pumped, January crashed, February is coming. The pattern is right there. Will it repeat? January 29th, 2026, 10:30 a.m. Eastern Time. Gold, $5,600 per ounce. Silver, well, $121. 60 minutes later, gold had collapsed to $5,100. Silver was at $108. If you had $100,000 in silver at that moment, you now had $89,000. $11,000 erased in the time it takes to watch a single episode of television. Liquidations triggering liquidations. Margin calls cascading through the system. Stop losses getting hunted in sequence. And somewhere in the world, someone was staring at their screen watching years of gains evaporate before they could even process what was happening. The financial media called it volatility, normal market behavior. Nothing to see here. They were lying. Because what happened that morning wasn't random. It wasn't unpredictable. And if you don't understand the actual mechanism behind this crash, you're walking blind into the next one. But here's what makes this interesting. This exact pattern had happened before. Not years ago, not even months ago, weeks ago. December 30th and 31st, 2025. The last 2 days of the year. Same crash, same panic, same liquidation cascade. And then January exploded. Gold up 30%, silver up 65%, the biggest monthly rally in decades. So the question isn't just what caused this crash. The question is whether we're watching the end of something or the beginning of something much bigger. And by the end of this, you'll understand the hidden force that moves these markets. The one thing most retail investors never watch, never even think about. The thing that tells you what gold and silver are about to do before they actually do it. Let me put the scale of this in perspective. $6 trillion in market value. Gone. In 1 hour. That's not a number you hear often. That's not a routine correction. That's a systemic shock moving through the market at a speed that suggests something broke. If you were leveraged, if you were using margin, if you bought call options expiring that week, you didn't just lose money, you got wiped out. Complete liquidation. Account balance, zero. And this is where it gets uncomfortable. Because crashes like this don't happen by accident. They're not weather events. They're not acts of God. Someone knew this was coming. The big players, the institutions, the ones with access to order flow data you'll never see, they positioned themselves before this happened. They saw the signals, they understood the setup, and when the crash hit, they were on the right side. They were the ones buying your panic sells. This is how wealth transfers work in real time, from the unprepared to the prepared, from those who react to those who position. And most people will never understand why they were on the wrong side. Here's what almost no one talks about. Gold and silver didn't crash because something was wrong with gold and silver. They crashed because of something else entirely, something called the DXY. If you don't know what that is, pay very close attention because this is probably the single most important thing you'll learn about these markets. DXY stands for the dollar index. It measures the strength of the US dollar against a basket of 6 major currencies: the euro, the yen, the British pound, the Swiss franc, the Canadian dollar, the Swedish krona. When the DXY goes up, it means the dollar is getting stronger relative to these currencies. When the DXY goes down, the dollar is getting weaker. Now, here's the part that changes everything. Gold and silver move opposite to the dollar. They are inversely correlated. Not sometimes, not occasionally, almost always. Let me explain this simply because understanding this is like getting the answer key to a test everyone else is taking blind. Gold and silver are priced in dollars. When the dollar gets stronger, it takes fewer dollars to buy the same amount of gold, so the dollar price of gold goes down. When the dollar gets weaker, it takes more dollars to buy the same amount of gold, so the dollar price goes up. Think of it like a seesaw. Dollar on one side, gold and silver on the other. When the dollar side goes up, the metal side goes down. When the dollar side goes down, the metal side goes up. They cannot both be elevated at the same time. The mechanism doesn't work that way. This is why professional traders don't just watch gold and silver charts. They watch the dollar. They watch the DXY obsessively. Because the DXY tells you what gold and silver are about to do before they actually do it. On January 29th, the DXY pumped hard. The dollar surged against other currencies. The dollar side of the seesaw went up. And gold and silver got crushed. This isn't manipulation. This isn't conspiracy. This is basic market mechanics that 90% of retail investors completely ignore. They watch gold, they watch silver, they stare at candlestick charts all day, but they never watch the dollar. And then they act surprised when this happens. By the time you see the red candle on your gold chart, the institutions have already sold. You're not predicting the move. You're the exit liquidity. So why did the dollar pump that day? Understanding the why helps you predict what comes next. There were 3 forces converging at the same moment. Miss any of them, and you miss the full picture. Force 1, the Federal Reserve. The Fed had been sending hawkish signals for weeks. Hawkish means they're leaning toward keeping interest rates high or even raising them, the opposite of dovish, which means rate cuts. And the Fed was very, very hawkish. Higher interest rates make the dollar more attractive to foreign investors. Simple reason. When rates are high, you earn more by holding dollars. Better yields on treasury bonds. Better returns on dollar-denominated assets. So what do foreign investors do? They buy dollars. They convert their euros, their yen, their pounds into dollars to capture those higher yields. More demand for dollars. Dollar price goes up, DXY rises. And when the DXY rises, gold and silver go down. The Fed hadn't cut rates as aggressively as the market expected. Everyone thought 2025 would be a year of dovish pivots. It wasn't. They were worried about inflation resurging. They talked tough. They said rates might stay elevated for longer. And the market always listens to the Fed. Force 2, China. This one specifically targeted silver. China's industrial activity was slowing. Manufacturing data showed contraction. Factory output declining, economic momentum fading. Now, why does this matter for silver? Because silver isn't just a precious metal, it's an industrial metal. More than 50% of silver demand comes from industrial applications. Solar panels, every single one requires silver. Electronics, your phone, your laptop, they all contain silver. Electric vehicles, every EV uses significantly more silver than a combustion engine car. Semiconductors, AI chips, data centers, all require silver. And where does most of this manufacturing happen? China. When China slows down, industrial demand fears spike. Traders start thinking, maybe silver demand will drop. Maybe fewer solar panels get manufactured. Maybe fewer electronics. Maybe less silver is needed. Fear hits. Selling accelerates. And silver, being more volatile than gold, being more tied to industrial demand, crashes harder. This is why silver dropped 11%, while gold dropped 9%. The China news hit silver harder because silver has an industrial component that gold doesn't. Force 3, political uncertainty. January 31st, 2 days away. The U.S. government was heading toward a shutdown if Congress didn't pass a funding bill. Shutdowns happen. They're usually temporary. They usually get resolved. But markets don't like uncertainty. Markets don't like political chaos. When there's uncertainty, traders reduce risk. They take profits. They move to the sidelines. They sell first and ask questions later. And after the massive rally earlier that month, there was a lot of profit sitting on the table. Gold up 30%. Silver up 65%. People were sitting on enormous gains. A lot of those people were looking for an excuse to take profits, a reason to lock in some gains. The shutdown fears gave them that excuse. It wasn't the primary cause, but it was the trigger, the justification that let people sell without feeling like they were making a mistake. Three forces, all hitting at the same moment. Fed hawkish, China slowing, shutdown looming. Each one alone might have caused a small dip. All three together, synchronized, $6 trillion evaporated in 60 minutes. Here's something most people get dangerously wrong. They think gold and silver move together, same direction, same intensity. That's not how it works. Yes, they move in the same direction, but not with the same intensity. Silver is gold on steroids. When gold moves 5%, silver moves 10% to 12%. Same direction, double the intensity. Gold goes up 10%, silver goes up 20%. Gold crashes 8%, silver crashes 15% to 20%. Look at what happened on January 29th. Gold dropped about 9% from $5,600 to $5,100. Silver dropped almost 11% from 121 to 108. This isn't coincidence. This is the silver multiplier effect. Gold leads, silver follows, but silver follows with amplified volatility. This is why silver made 65% gains in January, while gold made 30%. And this is why silver crashed harder. If you're trading silver, you need to internalize this. Silver will make you rich faster, but it will also destroy you faster. The leverage cuts both ways. Now, look at the crash that happened earlier that week, Monday. Just a few days before, silver crashed 14%, but gold only dropped 2%. Why? Because Monday's crash was silver-specific, driven by industrial demand fears, China-specific news, silver-specific selling. But the January 29th crash was different. Both gold and silver crashed together. Gold down 9%, silver down 11%. When both crash together like this, it tells you the cause is different. It's not metal specific, it's macro. And the macro cause that day was the dollar. The DXY pumped. Both metals dumped. This distinction matters because it tells you what to watch. If you want to predict the next crash, don't just watch gold. Don't just watch silver. Watch the dollar. Here's where this gets genuinely interesting. This exact pattern had happened before. Not years ago, not even months ago, weeks ago, December 30th and 31st, 2025. The last 2 days of the year. Sharp crash out of nowhere, panic selling everywhere, liquidations cascading through the system, red candles stacking, weak hands getting destroyed. The sentiment was catastrophic. Social media was full of doom. People calling for the end of the bull market. Gold and silver are finished. The top is in. Fear was maxed out. Despair was everywhere. And then January happened. Gold up 30% in a single month. Silver up 65% in a single month. Record highs not just broken but shattered. The biggest monthly rally in over 40 years. All those people who panicked in December, who sold at the bottom because they were terrified, who listened to the doom and gloom, they watched the rocket launch without them. They sold low. They missed everything. Now look at January 29th, 2 days before the end of the month. Sharp crash, panic selling, liquidations cascading. Same pattern, same timing, same fear. The question is whether February will repeat January, whether we'll see another massive pump. And here's why it might. First, understand what hasn't changed. The crash was about the dollar, about the Fed, about short-term fear, about weak hands getting shaken out. But the fundamentals, the big picture, the structural forces that actually matter over time, none of that changed, not even slightly. While retail was panicking, Tether was still buying 1 to 2 tons of gold every single week. They didn't stop because of a 60-minute crash. They don't care about your fear. They're accumulating. While you were watching red candles, BRICS nations were still stacking. China, Russia, India, they didn't sell that day. They bought. They always buy the dips. They've been doing this for years. While you were refreshing your portfolio, the de-dollarization trend was still accelerating. Countries are still moving away from dollar dependency. That didn't reverse in 60 minutes. While you were questioning everything, the supply deficit in silver was still real. 5 consecutive years of deficit. Mines are still depleting. You know what changed that day? Sentiment. That's it. Just sentiment. Weak hands panicked. Strong hands accumulated. And sentiment can flip instantly. It flipped negative that morning. It can flip positive the next. Second, look at what happens after sharp crashes in bull markets. Crashes are buying opportunities. They shake out weak hands. They reset overbought conditions. They create fear. And then the big players step in. They buy the fear. They accumulate at lower prices. They load up while retail is panicking. Then the rally resumes, often stronger than before. This has happened repeatedly in this bull market. But the question underneath all of this, are we still in a bull market? Look at the evidence. Gold is still massively up on the year, even after the crash. Silver is still showing enormous gains. Even after the dump, central banks are still buying. Record purchases continue. The dollar's long-term trend is still down. The spike on January 29th was a spike, not a trend reversal. Nothing suggests the bull market is over. Everything suggests this is a correction within a larger uptrend. But I could be wrong. And I know what you're thinking. Another person on the internet telling you to hold through the pain. Another voice saying, buy the dip. You've heard this before. Look, I understand. You're tired, you're scared. You just watched your portfolio drop double digits in an hour. But I'm not telling you what to do. I'm showing you the data. I'm showing you the patterns. I'm showing you what has happened before in identical situations. What you do with that information is your choice. So let me give you 3 scenarios. Then I'll give you a specific prediction. Scenario 1, the bull continues. This crash is exactly like December. A shakeout before the next leg up. February starts strong. New highs by March. Silver breaks $150. Gold breaks $6,000. Probability 60%. Scenario 2, more pain coming. The Fed gets more hawkish. Dollar keeps rising. China data deteriorates further. We see another crash. Gold tests $4,800. Silver tests $90. Probability 30%. Scenario 3, the chop zone. We go sideways. No new highs. No major crash. Just choppy, frustrating price action for weeks. Traders get bored. Retail gives up. Then the move comes when nobody expects it. Probability 10%.